And hello, everyone. So I want to pick up now on Chapter 11, Part 3, and this is an important concept that we have to go through and discuss, and it's called replacement versus expansion decisions. And I'm going to give you a simple example in real life that I have to deal with all the time, right? And I'm sure you will too. I don't know if some of you own a car that's old. I have a car that's old, right? It's I think about almost 11 years old now. And there's always the question, do I replace it and buy a brand new one, or do I do like an expansion of it? And my version of expansion with that car is to keep replacing parts and keep fixing it. Because at some point, let's say I dump like 1,000 or 2,000 into it, and then it really the engine goes. Then I just threw away the money, and they say the car's shot. You're gonna have to buy a new one. But so we're gonna talk about like this type of concept, all right? So so a lot of times companies have to make a decision to expand their activities, right? To expand it, and you have to buy new equipment and increase the capacity of a factory. And expansion is just when it is. Add another room for a restaurant. You know what I'm saying, right? And basically, you can look at the incremental cash flows for that. You got the initial investment to do the expansion, and then the operating flows are what you project will happen. So if Target, they give an example of Target. If Target opens up a new retail store in a town that had no Target stores, the initial investment would include the cost of opening the new store and stocking it with inventory. So operating cash flows would include all the cash inflows and outflows. So all cash flows are incremental because if Target does not open a store at this location, uh, it has no cash outflows or inflows. All right, so then we move on to the second item, and they talk about that in this next paragraph. Replacement decisions, right? So you don't want to open it. So here's now the replacement decision, right? Such decisions include replacing old equipment, which is what I was talking about with a car, upgrading computers and software, or remodeling facilities. Identifying incremental cash flows for these sort of investment projects is more complicated, right? Because the firm must compare the cash flows that result from the new investment to the cash flows that would have occurred if no investment had been made. So if the company buys like new equipment, basically to replace old ones, the initial investment includes the cost of the new equipment as well as any cash flows associated with the removal and sale of the old equipment. All right. So this is a lot more complicated. Um, so it's more complex, right? If Target remodels one of its existing stores, this is a kind of replacement decision because the remodeled store replaces the old one, right? So there's a lot more work involved in this. So they give a nice little chart here. Okay, relevant net cash flows for replacement. This is replacement decisions, right? So you have your initial investment needed to acquire the new asset minus the after-tax cash flows from a liquidation of the old asset. Again, so this table is a replacement. Replacement is a little more difficult than, you know, outright, basically doing a expansion. So that's important, right? All right, so we move on, and these two words are going to be very important, and you should know these just for the sake of knowing them for the rest of your life. And they're called sunk costs and opportunity costs. All right, so sunk costs, cash outlays that have already been made and cannot be recovered, whether or not the firm follows through and makes an investment. All right, so Here's an example of a sunk cost, which I was just referring to. If I sink $2,000 into fixing my car, okay, and I don't want to buy a new one because I think I'm going to save money. Now, if the car dies and goes, and they tell me, well, the car's shot. Sorry, you sunk the money in. That's the way it goes. Now I have to make an investment into a new car. So that money's sunk and gone. Everyone should be clear about that, right? It can't be recovered. And you can see that right here, right? Sunk, cannot be recovered. All right. So you should understand, and read this. You should understand. All right. Now, an opportunity cost are cash flows that the firm could have realized from the best alternative use of assets already in place. So when a firm undertakes a replacement project, it repurposes or replaces some portion of its existing assets to generate a new cash flow stream, and in doing so foregoes any of the future cash inflows that the existing assets would have provided had they not been replaced. Thus, the incremental operating cash flows for a replacement project will be the difference between the new operating flows and the foregone operating cash flows. So let's say I kept my old car, right, and it was hopefully it would still drive. I had an opportunity cost there, which was cheaper insurance because it was real old. But now if I replace it, I'm going to have to pay higher insurance, right? So opportunity costs represent cash flows that the firm will not realize as a result of using that asset in the proposed project. So I'm not going to realize cash flows of saving my car insurance, paying cheaper insurance because I had to buy a new car, right? So instead of paying $1,000 a year, I'm paying $2,000 a year. So right, so, and I have a nice example here, and you should read this example. And I'm going to try to play this video. I don't know if it's going to play for you, but let's see if you can hear it.
The first step in analyzing an investment project is usually estimating the incremental cash flows associated with the project. By incremental cash flows, we mean the difference between the cash flows that a firm would earn with the investment project compared to the cash flows that it would earn without the project. Sometimes determining which cash flows are incremental and which are not can be tricky. In this case, Janco Equipment can update a drill press that it already owns by cannibalizing a control system from an obsolete piece of equipment. The term obsolete seems to imply that the older equipment has no value, and therefore cannibalizing parts from that equipment is free and costs the firm nothing. But that thinking ignores the possibility that Janco could sell the equipment to someone else for $42,000 if the control system isn't cannibalized. If Janco cannibalizes the control system from its old equipment, they will give up the opportunity to sell that equipment for $42,000. In this case, we would say that the $42,000 is the opportunity cost of updating the drill press by using spare parts from an older machine. In many investment projects, there are opportunity costs, and they are not always easy to identify. Thinking about alternative uses for resources tied to a particular investment proposal will help you spot hidden opportunity costs. One cost that is easy to identify in this problem is the $237,000 cost of the drill press. However, that cost is irrelevant to the decision to update the machine or not. The original cost of the machine is a sunk cost, meaning that it cannot be recovered whether Janco updates the drill press or not. Sunk costs are irrelevant since they do not depend on the investment decision. In other words, the $237,000 cost is not incremental to this decision.
All right, so I hope everybody heard that. All right, so I'll knock off here and then we'll pick up. I'm kind of going to skip over international a little bit here, okay? You can read this on your own because there's a lot of things that make foreign investments a lot more difficult. You know, you have foreign currency problems. If the currency could flip, or problems in governments, you could have like political risk. So if you invest like in other countries, that could be a problem. So international capital budgeting is a very, very difficult thing because of a lot of things that could happen, all right? So there's a nice little blurb here about China. All right, so I'm going to move on. Let's see where we'll pick up for the next video. All right, so we'll pick up right here. All right, on my next video. All right, everybody. Talk to you soon.